Good evening, everyone. My name is Neil Bawa, and I'm your host tonight. My fellow partners, Anna Myers, John Bursey, and Cole Popper are with me, and we are super excited about this unique event. Say hello, everyone.
Hello.
Hey, guys.
All right. Many of you are probably wondering, Neil, why should I invest now instead of waiting on the sidelines for a better deal when these market conditions improve? Well, we have to say this. This opportunity is really only available to you because of current market conditions. This project represents the beginning of Grocapitus Phase 2. It is the first project that is based on our months of brainstorming on how to make our projects much more resilient in an economy that is much less resilient. And we wanted you to hear all about the anti-recession and anti-coronavirus safeguards that we have in place for this project. So in 40 minutes, you'll know exactly what makes this a powerhouse investment during these very uncertain times. So stick with us. Let's get started. To kick off, we'll give you a brief introduction to the management team for this project, and then we will review why we chose the Houston Metro. We will tour the submarket, and then we will explain why we cherry-picked this particular neighborhood. We will then tour the property, and then we're going to run through the assumptions, the returns, minimum investment, and time frame. As mentioned before, the focus is on resilience, on flexibility, and defensibility. We'll open up for a Q&A session at the end, which I am betting is going to be the most interesting one we've ever had.
Oh, yeah.
Some housekeeping. Feel free to type in your questions into the Q&A box. Anna will be asking us those questions at the end. You can also type in your comments. You'll get a recorded copy of this webinar in your mailbox tomorrow in case you need to jump off early. Please note numbers might change, though we think they're pretty dialed in. And our lawyer wants you to know that this webinar is not a solicitation to purchase securities. For that, you would need to review the PPM and the subscription docs. This is an informational summary, a marketing summary. It's not a substitute for your due diligence. All right, now for the team. I'll start off. I serve as founder and CEO for both Grocapitus and Multifamily University. Most of you on the call know us, and many dozens of you have invested in our projects. Now, you've trusted us with your money, and I'm quite happy to say that you've already seen the very positive post-coronavirus updates on the resiliency of our current portfolio. We spend a lot of time looking for best-of-class operating partners to work with, and we're super excited to be working with Urbanist, which is a multifamily investment company that's focused on wellness real estate projects in Houston, emphasis on wellness. We have a gut feeling that John and Cole and Luke and the rest of the Urbanist team all piled into Doc Brown's time machine, saw the post-coronavirus future, and then jumped back and designed a series of resilient projects. And when they came to Grocapitus, we helped them enhance those projects to make them even more defensible. University Oaks is the first of those projects. Here are some of our apartments and self-storage communities. When I look at this portfolio, I thank myself for being an industry where I have the cash flow to cushion the sharp pain that is about to come. We've been checking our community's cash flow, and many of them can pay a year of mortgage, even if their rents fall 50% or more. So it tells me we did the right thing by investing in boring apartments, and our investors will sleep well at night. Before I ask John to introduce the incredible Urbanist team, I want to spend 2 minutes sharing our thoughts about a post-coronavirus world. The thoughts that you will see were formed well before the coronavirus pandemic and will allow us to avoid the problems that other multifamily companies have found themselves in. So, what were we thinking? Change was upon us before COVID-19, and we recognized it. The multifamily value-add world was losing its value before the pandemic, and we saw that. So we created a 5-point change plan that we call Grocapitus 2.0. The main theme for Grocapitus 2.0 was that we needed to build a defensible moat around our projects. First, we needed higher resilience, which meant that we needed to move to projects with multiple exits, multiple buyer pools, multiple renter audiences. Also, we needed to speed up our projects and reduce our construction timelines. Speed to cash flow was key, so the projects themselves had to shrink in size. So we bought out the shrink ray gun. We also needed to have something unique for differentiation. So combining solar and EV charging for our self-storage projects and adding wellness for our new construction multifamily project. We needed to create offerings that were productized like an assembly line. So we could also give our investors more than the one standard exit that syndication investment offer, and give ourselves the ability to exit at different times. And finally, and this last step has been added after the pandemic, we needed projects that get around the horrible new impound restrictions from lenders that are on value-add projects. These are short-term restrictions. We think they'll disappear in a year. But in the meantime, it's super hard to buy value-add projects at a reasonable risk-reward. So we needed a completely new kind of project. Now, this doesn't mean we won't go back to doing large apartment projects in the future. We love them, and we will go back to them at the right time. But for now, our focus has to change to meet the needs of our investors and the risks that are in the marketplace. Now, we never thought that all of these resilience initiatives would be in a single project. We think of these as menu items, not a buffet. But University Oaks, which is the first project in Grocapitus 2.0, meets all of these criteria. And I'm going to ask John Birchsey from Urbanist to introduce his team so we can learn more about this project. John?
Thanks, Neil. Good evening, everyone. I'm Jonathan Birchsey, the Managing Director of Urbanist. On an almost identical wavelength to Grocapitus, we founded Urbanist to programmatically create boutique urban infill communities with an underlying focus on wellness real estate, adding innovation and design to develop a product that's both tenant and investor optimized. Our project offers investors a truly relevant product for this decade, perhaps even more so in a post-corona environment. It also offers a compressed development timeline and delivers a nimble asset. On average, our directors and stakeholders have over 15 years of real estate experience, ranging from $200,000 rehabs to $20 million luxury estates, master planned communities, and $100 million office buildings in the US and internationally. A few more details about me. I've been a real estate business owner since 2014, which includes lending private and institutional capital to construction projects and growing a 60-person brokerage. For 6 years prior to that, I worked in financial services, working with multi-billion-dollar quant funds, and I began my career as an accountant for the Ministry of Defence in London. We also have Cole on the webinar, who's our Houstonian expert, and in his first 5 years, he transacted over $100 million of real estate. This puts him well within the top 1% of realtors nationwide. Cole has been a partner in 16 developments, and he serves as our Director of Acquisitions and Sales. For those of you who will watch the interview with Asset Living, our property management partner, you'll recognize Nathan, our VP of Business Development, who's got an impressive corporate background and has been a principal investor in more than 10 projects. And here's our development director, Luke Marvel, who recently completed the Barracks, the largest student housing development in the whole country, spanning 170 acres with over 3,000 beds. We're exceptionally proud to have him on our team, as he's one of the most experienced low-rise multifamily developers in Texas. If anyone would like to hear more about Luke, there's a pre-recorded interview available for download. And now, handing over to Anna.
Thanks, John. Hey, everybody. Like Neil, I'm incredibly excited about the expansion of our core business to include smaller, nimbler projects. I'm also really proud of the hard work we're doing with our current portfolio for both our investors as well as our residents. I want to assure you that any project we take on, we manage like beasts, whether in good times or in bad. A fellow beast you should know about is our financial controller, Loretta Hayes. She adds tremendous value to our projects with her decades of experience in both the construction and the multifamily industry. Every month, she scours the construction schedules and property financials, looking for trends or dark holes. Our team also includes a virtual army, starting with our efficiency center, which Nadine manages like a phenom. They use cutting-edge marketing technology to help our properties lease up and optimize our properties in lots of ways. And then we have our equity squad, headed by our wonderful transaction coordinator, April. If any of you will be investing with us, you will be talking with her quite a bit. Okay, let's get going. I just love this picture of downtown Houston. It is truly remarkable how much new construction has happened there over the past 20 years. In that time, over $9 billion has been invested in the downtown district to renew the urban core. The urban core, wow, those are big numbers. And they say everything's bigger in Texas. Apparently it's true. With an avalanche of accolades, Houston keeps the excitement coming. first place awards like fastest growing city, best place to live, best market to purchase multifamily, best city for millennials, most diverse city in the US, best seaport. Really? I didn't know that. Second top housing market for new homes. Wow, so many impressive accolades, Houston. And there's many more. We just couldn't fit them all into one slide. But one I do want to mention that's not here is that Houston is home to the world's largest medical center. Yep, we'll be coming back to talk about that giant later. Well, first, let's get you oriented to the Houston Metro and where our project is. We've zoomed the map to the metro level. You can see downtown Houston here, and our project location is in pink, just a short 10-minute drive away. You can also see Houston's two main airports in yellow. By the way, Houston's airport system is proudly the 4th largest in the nation. But what about jobs? Oh, Houston's got the jobs. It's the nation's #2 job creator in 2019 and was the #1 highest growth city in the US in 2018. Those are impressive. And let's not forget that it is home to 22 Fortune 500 companies. That's only second to New York. Also super notable, it was one of the least impacted cities during the last recession of 2008. And Houston has had the lowest level of unemployment over 2 decades, thanks to a massive influx of population growth. So let's talk about population. Since 2010, Houston added nearly 1.1 million residents. In 2019 alone, Houston added another 90,000, boosting the region's population to nearly 7 million. And Greater Houston's population is forecast to surpass 10 million by the year 2040. 10 million. Big numbers, again, big. And did you know that Houston is already the #1 largest metro in Texas and #4 in the country in terms of population? Knocking on #3's door. Okay, but brace yourself for the job growth. Between now and 2045, Houston is projected to add 6 out of every 10 jobs added in Texas. So let's put that in perspective. That is more jobs added in Houston compared to Austin, Dallas, Fort Worth, San Antonio, all the towns across Texas combined.
That's astonishing. That is amazing.
It really is amazing. And Neil, as if jobs were not enough, with 2,000 new population arriving weekly, Houston's population is growing at an astonishing 4 times faster than the US population growth. That's 400% higher than the US. That's impressive. But what about the oil, you ask? Houston and oil. Well, we have witnessed oil collapses before. In 1990, oil prices dropped below $20 per barrel. But Houston, in that time, they found a way to rise from the ashes and they grew exponentially. Today, we're seeing history repeat itself with oil prices that were recently at the $20 and $30 mark. But now, fewer wells are drilled, rig counts may be falling, orders for new equipment were drying up, and layoffs were soon to follow. But while America's oil and gas markets were negatively impacted by the oil price war between Russia and Saudi Arabia, the outlook we predict for Houston is a story of rapid recovery from a moderate recession in an otherwise stable and healthy condition. That's because the oil price war that occurred between Russia and Saudi Arabia, it was unsustainable as both economies rely almost entirely on oil and gas. And on top of that, the US government directly intervened to stabilize the price of oil. This is unusual for the US, but admit it, we're living in unusual times. And by the way, if you have not heard, the oil price war is over on Sunday when parties reached a truce to cut production by almost 10% to stabilize prices. To illustrate this further, in 2019, the Texas energy sector declined for 10 straight months. Ouch. Despite weaker oil and gas prices, job losses, falling rig count, Houston still managed to add 63,400 jobs, and they took the #2 city spot for job growth in the US. That's huge.
So they lost a ton of oil jobs and still ended up being the second fastest growing city in the country.
You got it, Neil. For a city named the energy capital of the world, this clearly illustrates the strength, resilience, and diversity of Houston's economy. It's not all about oil. That's the past. Today, Houston is all about the cutting edge healthcare, aerospace, clinical research, innovations. So the way we see it, Houston's key sectors will carry the city through this year's energy woes, and the Houston economy will be relatively resilient to recession, much more likely to bounce back faster compared to other metros. You see that pie graph there? That is poetry to the eyes of data geeks like us. And if any US economy is going to outperform, count Houston in. Employment forecasts for 2020 predicted the creation of 42,000 jobs despite weak nationwide conditions. Not surprisingly, we're going to see jobs lost in energy, retail, accommodations, hotels, anybody? In the aftermath of coronavirus. But notice in this forecast chart, we see the bulk of new jobs coming from healthcare and government. Also, the Institute for Regional Forecasting separately, they predict that the 2021 job growth is likely to be up 60,000, even if both the COVID-19 and oil price war is medium or severe. Well, that's great news for Houston, and it's a testament to its diversified economy, which is led by that giant we mentioned earlier, the Texas Medical Center. It's not just massive, it's the largest medical complex in the world with its very own zip code. Okay, that's crazy. There are 21 renowned hospitals, 8 academic and research institutions, and 50 not-for-profit organizations, all in one campus. It's home for 21,000 physicians, scientists, and researchers. If anyone is going to find a cure for coronavirus, my bet is on these people. Check this video out, and after that, our local Houstonian Cole is going to dive in to continue our journey.
The Texas Medical Center is the largest medical center on planet Earth. In fact, you can take the second largest and the third largest, combine them, they still don't touch the Texas Medical Center. It's staggering. There are 110,000 employees, 170,000 operations a year. It's the largest collection of doctors on the planet.
The scale here and the quality of excellence here is staggering. More patients come here, more clinical research happens on this campus. It's the highest concentration of awarded scientists in the world, where you can drive from research to clinical care faster than any other place on Earth.
What we're trying to do here is take healthcare innovations and research and turn them into products that can help patients.
This is a partnership between the Texas Medical Center, the member institutions, and industry.
We want the best of the best here, and they are coming, and they're coming in droves. J&J, the largest life science company in the world, here. Next was AT&T. Now we're working with Apple. We are creating this machinery of innovation that is unstoppable. The momentum is real. It's a place that will change the way in which discovery is done.
An innovation that is occurring here is tremendous. That you cannot replicate.
We have an unfair advantage. We're already together on one campus. This is the beginning of building a life sciences industry in Texas.
One thing that wasn't mentioned in the video is that an additional 30,000 new jobs are being created at the medical center. And all of these people are going to have a place to live. Also, in our opinion, there's going to be a big increase in rental demand for high quality wellness apartments from both medical professionals as well as outpatient care, especially after this coronavirus experience that we're in the middle of and people's new awareness to the importance of their health. What we are building is the perfect product and location to fill this upcoming demand. Here's a picture of the medical center right next to Rice University. And many people outside of Houston think that it's a pretty spread out city, but it's not. You can see Houston's downtown skyline in the distance, which is only 3 miles away. Both of these areas are major employment hubs, and all of the recent development has significantly increased their curb appeal. To give you perspective, here's a map of the inner city. You can see a bubble or a circle with University Oaks neighborhood. That's where our project is located. You can also see the Texas Medical Center to the west. And in the prior video, you saw how dynamic of an area that is and how many people depend on getting to the med center for either work or school. Well, we're less than 10 minutes away. To the north are both downtown and midtown, which are the places to be for nightlife, dining, and sports. It's where most people spend their time on the weekends. We're also minutes away from Houston's main universities. So most of you have heard about Hurricane Harvey and know the floods it produced across the Houston area. However, our sites did not flood at all during Harvey or any other flood in Houston history, and we are completely outside of any floodplain. It's also worth noting that Houston spent billions of dollars on anti-flood infrastructure to make sure the effects of Hurricane Harvey never happen again. So let's dig into the submarket. Our project is in one of the best locations for multifamily development in the city of Houston, if not the country. I can confidently say that because of its close proximity to all the main areas in Houston that I previously mentioned, as well as the scarcity for multifamily development sites. We're surrounded by single-family deed-restricted communities, which means commercial multifamily sites are very hard to come by. Look at this chart. You can see a pink line amongst a bunch of blue ones. That's us. And it shows our neighborhood appreciation and land value. Our neighborhood's land value has increased by over 50% in the last 5 years. Again, that's over 50% in the last 5 years. Houses in our area have also seen incredible appreciation. Home prices in our specific census tract have increased by 73% in the last 10 years and 145% in the last 20 years. Truly incredible. These are some of the highest growth rates in the country for both land and also houses. Our submarket is thriving. Let's take a look at what's happening in the area and why this trend will continue.
Right, great points, Cole. So another factor driving local appreciation are the universities. We're a 10-minute drive to Rice University, the Ivy League of the South, and a few minutes walk to U of H, the 19th biggest college in the country, with total enrollment of nearly 50,000 students. U of H contributes $3 billion annually to the Texas economy while generating 24,000 jobs in Houston. So Cole explained some of the reasons behind the exceptional historic and ongoing appreciation, and I want to describe what we've got to look forward to in the immediate vicinity. I really like this slide, which comes from the university's Centennial Master Plan. The green outline directly opposite our sites is the biggest park in the area, and there are 2 light rail stations at the north and southeast corners for easy access to the northern side of campus and downtown. U of H is a huge campus, and they're focused more than ever before on making a huge improvement in time for their 100th anniversary in 2027. Each of the red buildings is one of 27 approved development projects. They're spending over $1 billion during the next 3 years. This is more investment than any other Texan university. And the closest U of H expansion is the upcoming $100 million medical campus. This will be the most prestigious part of the university, and less than a 5-minute walk from our project. The new medical campus will consist of 13 high-tech buildings. And this is a render of the main building, which is due to open in 2022. I think this is a major point, as we believe our project will be the most attractive option for these medical students, and just a short walk away. On a similar vein, Texas A&M, which is another major university, they're currently building a $550 million medical campus 10 minutes away next to the medical center. Lots for our investors and end buyers to look forward to. And now Neil is going to talk more about the surrounding neighborhood.
Thank you, John. Everyone, as you can imagine, this explosive growth in the area has led to ultra-low unemployment rates of 2.5%. Now, while these numbers are going to spike big time due to coronavirus, we do expect them to settle back down close to these numbers 14 months from now, when we'll be renting up or selling our units. What's even better is that a majority of the jobs in the area are white-collar jobs, and there's plenty of high-paying jobs within an hour's drive. Now, keep in mind, coronavirus impacts blue-collar workers a lot more than it impacts white-collar workers. These workers are not serving in restaurants or making beds in hotels. Home prices in this area have exploded in the last 5 to 10 years. That matches the top-notch quality of the project. The area has a very clear track record of gentrification. So more people come into the neighborhood, which leads to more high-paying jobs. And that stunning medical campus that's a stone's throw away is going to host a lot of new high-paying jobs in this part of Houston. Did we tell you that this area is a federal opportunity zone? While we're not running this project as an opportunity zone eligible project, we can still see huge benefit from the tax exempt status of the zone, because we do plan to sell some of our quadplexes to buyers who want to use OZ tax benefits for huge tax saving. Many of you are familiar with InvestReal.com's opportunity zone ranking engine. This engine compares this zone to 8,700 other opportunity zones in the US. Well, pretty much blows the rest away, all 97% of them. Its population growth rate is higher than 89% of other opportunity zones. And so it goes. House value growth rate, higher than 90% of other zones. Rent value growth rate, higher than 92%. Bottom line, the InvestReal engine confirms that this is a terrific opportunity zone census tract. Back to you, Cole.
So let's talk about our project and why it's such a strong investment. Our developments are more similar to single-family residential construction in both cost and timelines than compared to mid-rise or high-rise construction. Cheaper vertical construction costs allow us to repurpose development dollars and put it where it matters the most, like interior quality and finishes that a tenant can actually see and enjoy. Our shorter construction timelines reduces not only the development risk, but it gets us to positive cash flow more quickly. Because we have designed projects that are attractive, boutique, and designed for repeatable scale, we've been able to forge partnerships with some of the best companies in the country, like Grocapitus, who we're extremely excited to work with. And all of you know how great Neil, Anna, and the rest of their team is. Well, we've also partnered with Asset Living. Asset Living is the largest student housing management company in the country. They manage over 130,000 beds, and they're actually headquartered right here in Houston, so they intimately know the local market. Before us, they selected one of their property at University of Houston to manage, and it's called the Icon. Well, that one building happens to have the highest occupancy rate of all existing properties. So on this slide, you'll see the top 4 off-campus U of H student housing buildings, and this is their fall 2019 occupancy rates, where you can see the average occupancy rate for all 4 buildings is 95%. And Asset Living's building, the Icon, was 100% occupied. That's hard to beat. In the middle of coronavirus, 3 out of the 4 properties dropped by an average of 8% in occupancy, but the Icon, which is managed by our partner, Asset Living, only dropped by 2.4%. At that occupancy rate, most people would think, oh, well, the Icon must be the cheapest. Well, it's not. Their 2-bedroom unit is actually the most expensive. So that speaks to the strength of having a solid management partner like Asset Living.
Yeah, Cole, I just wanted to add that our independent underwriter, who is not easily impressed, he felt that the rent comps that were used in the underwriting almost seemed too low at $2,300 and $2.25 a square foot based on his research. So we always appreciate conservative underwriting, and that really adds to the strength of this project.
Absolutely, Anna. That's a great point. And when we actually take a dive and look at U of H student housing supply and demand, it's important to know that 78% of the students live off campus. This is a really high percentage versus other Texas colleges, and this trend will continue because unlike most universities, the University of Houston does not require its freshmen to live on campus. Also, take note of the last bullet point on this slide. The average rental rate for off-campus housing at U of H is $2.40 per square foot. This is actually higher than the average rental rate for apartments around Houston, and this is due to the obvious demand for off-campus student housing at U of H. So as I previously mentioned, we have reduced construction costs and shorter construction timelines than our competitors, which means we don't have to charge a premium to drive a profit. Our pricing is actually below the market average, and we're only delivering 64 beds or 3% of our submarket supply. So both us and Asset Living are expecting to be 100% pre-leased prior to the completion of construction. Let's take a look at our site plan. So just to be clear, we have two identical sites that are on the same street and 1 block away from each other. One of the biggest challenges when dealing with smaller sites is figuring out how to optimize the layout to balance the density with functionality and lifestyle. But with countless hours in collaboration with our architect, interior designers, and our property manager, we've created what we feel is an optimized site plan for what we were trying to achieve. That's flexibility of sales, boutique community, spacious floor plans, parking spaces for every tenant, and functional outdoor amenity space. On each of our 20,000 square foot sites, we were able to fit 4 fourplex buildings, which is 16 units per site, or 32 units over both sites. Every unit is a 2-bed, 2-bath, and just over 1,000 square feet. John will tell you more about the property inclusions.
So from a tenant perspective, our product has 3 primary unique selling points: design, advanced smart home automation, and my personal favorite, Delos' healthy home platform. To repeat Cole's point just one more time, we're able to repurpose construction dollars that typically go into steel, concrete, elevators, and resort-style amenities, as well as higher labor costs, to where we think it matters most. Although we've highlighted our immediate proximity to U of H, we're not limited to undergrad and graduate students. Our product was designed to be a first-class option for a variety of tenants, including professionals working downtown, medical staff, and even outpatients, which our team have already explored. By having 2 identical sites a few hundred feet away, it provides another level of flexibility for our target audience and range of tenants that might be interested in living here. Given the very high occupancy in the area, along with Asset Living, and even leveraging Grocapitus' efficiency center, our group's consensus is that our 32 units may be oversubscribed. I mean, really, it's an attractive option for anyone that wants to live within a subtly luxurious boutique community. The future of multifamily, in my opinion. And as I mentioned, one of our primary value adds is our healthy home platform. Upcoming is a short video about Delos. They're the world's leading brand for wellness real estate, and they invented the internationally recognized well building standard. We did a licensing deal to have the first Delos branded healthy apartment buildings in Texas.
When you consider that our physical and social environment are the largest determinants of our health, and we're now spending up to 90% of our time indoors, wouldn't it be great if we could enjoy the benefits of nature and the great outdoors inside our homes? Imagine a home that actually nurtures your health and well-being, where mornings feel positive and energizing, the air filtered, invigorating and refreshing, the water purified, cleansing and rehydrating, and the circadian lighting helping align your body's natural cycle. Imagine a home that passively enhances its natural elements to help support and care for the ones you love. From the pioneers of wellness real estate and the founders of the Well Building Standard comes Darwin, the world's first home wellness intelligence platform. By actively monitoring, calibrating and responding to environmental conditions in your home and enhancing its natural elements, Darwin constantly nurtures your family's health and well-being at home, every day. Welcome home to wellness. Welcome home to Darwin.
Awesome. I could spend many slides talking about Delos and our healthy home offering, but I'll try to be concise. We can see all around us that wellness is one of the fastest growing industries, including lifestyle, exercise, and eating habits. When combined with the world's largest asset class, real estate, you get a staggering $50 billion a year wellness real estate industry, and that's just in the US. Yet developers are only just starting to include this latest amenity, and unsurprisingly, you can see there's a strong business case, especially when leveraging the leading brand in the world. So every unit will have an intelligent home health dashboard on a tablet on the wall. When you walk in, you can now visually see that, among other things, the fact that the air quality in your home is always 2 to 5 times better than outside. This will blow people away, and I think many people will be reluctant to move out. The best thing about it, you don't have to do anything to reap the benefits. I want to stress that we're not factoring in any premium into our underwriting. So if we find that renters in Houston are willing to pay more, post-Corona this is even more likely, then great. Our cash flow and sales price will be higher. Safety and security. Of course, we take this very seriously. So just like the other Class A buildings in our submarket, which have high occupancy and rents, there's gated security with 24-hour video surveillance, secure and private garage parking, as well as smart locking systems for each building and unit. Crime has been confined to interior lots that are less gentrified, and it's worth noting that according to the 2019 U of H police report, there was only one incident of burglary at an off-campus property since 2016, and that's relative to a college with 47,000 students. As Cole mentioned, a lot of effort has gone into providing a beautiful environment with a focus on greenery, yet very low maintenance. On each 16-unit site, we have 6 manicured amenity areas, great for grilling or relaxing, and if tenants want more space, there's a large park opposite. We provide 1 electric vehicle charging station per site, and one of the coolest outdoor amenities we have are electric bicycles. These are fun and practical to use, but since we're in the center of town, providing electric bikes enables tenants to eliminate the need for a car and save a big expense, if they so wish. Overall, we're facilitating a greener, healthier lifestyle while accommodating a variety of amenity and transport needs. The situation we're in right now has caused a lot of people to appreciate green space even more. A key outdoor amenity is, of course, having an 83-acre park on your doorstep. This is the biggest in the area. There's a baseball field, tennis courts, and even a jogging trail. So in a post-Corona world, it's possible that some people will decide to scrap public gym memberships and take exercise outdoors to avoid confinement and machine sharing. Also, not having to drive and look for parking is definitely a luxury for our tenants.
Exactly, John. I definitely value being outside more now than ever. So let's take a look at some of our renderings of our project to give you an understanding of how unique our community is. Our goal is to create spaces that wow our tenants, but are also cost effective and easy to maintain. Like utilizing these maintenance-free green walls to separate 1 open grass area into 3 secluded amenity areas for our tenants to privately enjoy. Our electric bikes will be secure at the back of the property next to our EV charging station. Again, we're close to everything, so even if you're too lazy to pedal, the bike can take you wherever you want to go because it has an electric-powered motor. As John mentioned, these bikes are a fun and practical way of getting around. From the moment our tenants enter the door, they're going to be amazed by how luxurious our units are. They'll be able to feel and smell the difference in air quality from Delos and experience the convenience in their day-to-day living from smart home automation features, making this a place that they will not want to leave. The typical ceiling height in new Class A multifamily units is 9 feet. But to give our tenants that noticeable extra sense of space, we decided to increase our ceiling heights to 10 feet. The increased ceiling height along with large windows creates a significant amount of natural light in all of our units. And every unit has their own private balcony. From fixtures and fittings to appliances and accents, our designers have selected affordable luxury options that look great, but are also durable. Simple, cost-effective touches such as accent walls help create more unique and memorable spaces. Each unit is also provided with 2 full bathrooms. One is equipped with a shower and bathtub combination, and the second is a walk-in stand-up shower. It's rare to see bathrooms this nice, except for in really high-end condos or custom homes.
As you can see, there's been a significant amount of preparation and attention to detail into every aspect of the project, both from a tenant experience perspective, but how we can be confident that rents and occupancy will outperform competitor buildings. even though we've underwritten to market averages. So to bring you up to speed on project status, we have completed the following: surveys, environmentals, city water and drainage capacity, architectural design, civil design, and rezoning approval, including public hearings. The benefits for you as potential investors thinking about investing at this stage: having completed land development and design work, we now have a much shorter timeline, so we're faster to cash flow and exit, thus increasing returns, and essentially have partially de-risked the project. Our capital was first in and our profits are last out. Notably, our development consultants are hands down some of the best in Texas. Same with our corporate partners. Of course, Grocapitus, Delos, Asset Living, and even our attorney, DLA Piper. We have treated this 32-unit project as if it's a $50 million plus project because we were designing and preparing for the next 5. That also means each small balance multifamily project enjoys economies of scale and the level of service expected for an institutional grade asset.
So to me, this project is really a godsend in times of uncertainty. First of all, most larger developments won't be able to obtain construction financing in times like these, especially at a decent rate. However, because of Luke's stellar reputation and his influence and standing relationship with Texan banks, we already have an approved loan at an ultra low rate of 4.75. That's unheard of. And yes, we freshly confirmed this loan after the pandemic outbreak. Secondly, we're seeing a boom in wellness real estate, which represents a gold mine opportunity, especially post-pandemic when everyone is settling back into a life of somewhat normalcy. Third, the boutique project has no unnecessary amenities, but instead features large outdoor spaces for social distancing, and is overall, I believe, more desirable for resident life after Corona. Most important, though, is flexibility. So together with our partners and independent underwriters, we've concocted a multitude of exit scenarios, which gives us just the flexibility we need to chop and change our strategy as the situation progresses and act in the best interest of our investors. Lastly, the pool of potential buyers that we can sell to is virtually bottomless, something that none of our previous 12 projects could have claimed. I mean, just look at this list of buyers. Multifamily investors can use very lucrative small balance loans to buy the entire project. Opportunity zone investors and 1031 buyers can get massive tax benefits by buying quads, individual quads. Our own investors can choose to buy them. Student housing operators and investors will want to buy them. At 32 units, the project is large enough for a small publicly traded REIT to buy. We can also sell it as part of a larger portfolio because, as we've hinted multiple times, we're going to be doing a number of these projects in Houston. And then we've got options for furnished corporate rentals, as well as an option for condo conversion, so we can also sell as 32 separate units. So lots of options, but options are priceless in a post-coronavirus world. And here's a summary of our exit options. Unlike all of our past projects, we have 4 different exit options, and our default option is this green one on the right. We want to hold for 5 years, but in a post-corona world, we don't want to deal with debt. So in this option, we pre-sell 3 of our quadplexes now, and we close them at certificate of occupancy when the construction is done. We pay off almost all of our construction loan and hold it pretty much debt-free for 4 more years. This gives us equity level returns at debt level of risk for 80% of the project's timeline. In this strategy, we average equity returns we're basically looking at doubling your money with an IRR of almost 19% and average annualized returns of almost 23%. But what if the for sale market is not in a happy place 14 months from now? Well, we lease up, then refinance, then get into a longer term loan and hold for 3 more years. The returns are quite similar, but in this option, we do end up with debt, just like our other projects. We also have 2 more options. First, we build in a year, we lease up in the 2nd year, and we sell the whole project at the end of 2 years. Much higher annualized returns in IRR, but a shorter project. To us, this is the second best option if we cannot execute the green option on the right. Finally, we have a less likely home run option. If 14 months from now, the market has recovered fully and truly appreciates our wellness unit and units in our location, we sell at peak for extraordinary returns. Again, we'd much rather sell 3 units and hold without debt for 5 years, but it's super nice to have this option in case the economy recovers faster than we think it will. Here's a very unique slide. For the first time ever, our investors have the additional option of buying a piece of our project. This is a resiliency feature for the project, but it's a flexibility feature for our investors. As we mentioned, we're going to sell 3 of the 8 quadplexes about 14 months from now to pay off our construction loan. The investors who are investing at least $100,000 in the project have the additional option to put down a tiny deposit now to buy a 4-plex at completion. And they have a 90 days, no questions asked cooling off period if they change their mind. This is a phenomenal option because you have 0 construction risk beyond the tiny deposit. You're not signing on recourse loans, and you get a leased up brand new property when you buy it from us at a fixed price, knowing what the rents are going to be when you buy it at that price. Even better, you get a $25,000 discount towards the purchase of that quadplex. That's an additional 25% return in 1 year. You can buy the quadplex using cash. You can use 1031 money next year. You can use opportunity zone money next year. We will also help to arrange lending from the top quadplex lender in the entire country. Now, I want to stress, this is just an option. If buying a quadplex is not in your wheelhouse, just ignore this option. Just invest in the project as a regular syndication investment. Just know that some of our cash flow investors will very, very quickly execute the option of buying these 3 quadplexes, and that's going to make your syndication investment even more resilient. So if you're interested in this option, in addition to the syndication investment, we have a mini webinar on this specific aspect that's going to be held on Thursday, April 16th at 4 p.m. Pacific, 7 p.m. Eastern. And we're going to explain the cost, the equity needs, the timeline, the lending, the expected cash flow, all in this mini webinar. How do you sign up? Well, in the poll that's coming up in 5 minutes, we're going to give you the option of attending this webinar as well. So it's optional. Take a look and answer the poll in 5 minutes so we know if you're interested. Now let's end this presentation with a little number crunching and take a very quick look at the financials. Okay, so the management team, our investors too, we're investing $250,000 of our hard-earned money into the deal. That's almost 8% of the equity. Most of our deals tend to be closer to 5%. We're assuming a $4.8 million construction loan. The project size is $8.1 million. We're raising $3 million in equity. We have over 1,000 investors that signed up for our 2 webinars, so we do expect the raise to end very, very quickly. The minimum investment is $75K, although investors who invest $100K or more will have first dibs to the shares, and only $100K investors have the option of pre-buying those quadplexes at a discount. First-time investors with Grocapitus can ask to be placed on standby if they only want to invest $50K. In terms of fees, we're charging a 7% developer fee. The asset management fee is 2% of gross collected rents. Now, this is a 506C offering, so accredited investors only. We're offering investors an 8% pref or preferred return, and the profits are split 60-40 between investors and general partners. We know this is a higher split than some of our other projects, but do keep in mind that we're shrinking our projects to make them much quicker to execute and much more resilient, and we do take a massive hit to our pocketbooks when we do that, so we're balancing it out. All right, let's finish by looking at projected cash flow. First year is construction, no cash flow. Cash flow starts in year 2, but it starts very quickly because this is a very compressed construction timeline. So you can expect about 10% in year 2, year 3, year 4, and year 5. The big chunk obviously comes on sale in the 5th year. And then it's really great for those of you that have big W-2s, that the huge difference between ordinary income and capital gains taxes for this amount. Okay. Bottom line, we believe that we're going to make over 23% annualized returns for you based on this exit model. And remember, there's nothing in this model about the benefit from a Delos wellness home. So your projected returns are about 214%. That includes your principal for an equity multiple of 2.15x. And that's our presentation, folks. We know many of you have questions, so use the Q&A box. We'll take questions. Now, very important, we are putting up a poll so you can let us know if you're interested. Please answer the poll. It is absolutely critical. So we'll leave the poll up until the end of the webinar.
Okay, Neil, you ready? Ready, gang,
Yep.
for questions? We got some questions.
Yep.
Okay, top it off with, why should we invest in this project now instead of waiting for the coronavirus situation to improve?
That's a very good question. I mean, I knew I was going to get hit with this question, so I'm glad I'm answering it up front, right? So 3 reasons. Firstly, we've worked super hard to de-risk this project. So you can invest with confidence today. Leaving your money in the bank is going to make you nothing. Investing in a project designed to be resilient in a post-corona world is a better use for that money, honestly. Secondly, the blunt truth is that individual investors like you only really have access to a project like University Oaks because of the coronavirus. In normal times, we'd set the minimum to $250,000 given the benefits of the project. Also in normal time, we would just take money from institutional investors or 1031 or OZ investors. We wouldn't take money from individuals. Third reason, in normal times, companies like Grocapitus and Urbanist usually focus on larger projects. You know, it's best for our pocketbook, and it gives us a lot more money. So we're not focusing on these kinds of projects today only because of the risk in the marketplace. We know that this project is at a lower risk level. You know, it avoids all of the tenant non-payment that value-add projects are going to see for the rest of this year. So, I mean, my bottom line is you're unlikely to get access to this kind of project in the future.
No, perhaps just another couple of comments.
Yep.
Those of you who do believe we're going to return to a normal, or at least a new normal, say from fall 2021, so in about 15 to 18 months from now, if you're investing capital now, just like we are, your money's invested during construction. So if this is a pandemic-induced recession, for 2020, next year coming out the other side, and hopefully we've got another full cycle to look forward to.
That makes perfect sense. Yeah.
Okay, next, wouldn't the coronavirus-related shutdowns slow down your construction schedule?
Well, we don't think so at all. Construction is deemed an essential activity, so we can continue building during shutdowns. Also, we've recently seen, and this is not anecdotal, it's based on our other projects, we've seen a huge increase in availability of construction staff. And a lot of that is because there are states that have shut them down, so people have moved over to states that consider them to be essential. We have a project in St. George, and that project had 2 framing crews, and we were struggling to staff it. Today, we have 3 framing crews and are prepping for a 4th. People have just come in from other states, and also people that have gotten laid off in other sectors that used to be in the construction industry are returning to the construction industry because they know that it is an essential activity, so it's less likely to be affected. So could we see some delays? Yes, but we've also got some benefits that we're not factoring in.
Yeah, Neil, just to add to your comment there, and I don't know if the audience have seen Luke Marvel's interview, and he makes a good point on this. You know, we've got a small project. Obviously, the construction lender is behind this because they believe on what's coming out the other side in a year or so's time. But you know, if you're a developer or a lender on a $50 million plus project, those projects may be delayed for various reasons, and so there might be an actual increased availability of labor, during the next year for us.
Yep, I believe that. I think that we're going to see a significant increase in labor because of the nature of what we are going through, and it's going to help us with this project.
Okay, so many people asking, is this a student housing project or a multifamily project?
Well, it's a hybrid, and it's deliberately designed to be a hybrid. The rents are high enough so that we can make it a multifamily project, but we think that we get the highest rent delta by letting students in, right? So 2 students in a 2-bedroom unit. So we've hedged by keeping both of these audience in mind. We are hedging our bets once again: flexibility, resilience. We're increasing our tenant audience. We're maximizing our rent profits. And we also now get buyers from both the multifamily market and the student housing market. So we did choose a student housing property manager because they're simply the best and the biggest property manager for this area. I mean, and their advice is really going to be critical for us when we decide which way to go with tenants, student housing or multifamily. The honest answer is we're keeping our options open because that's what makes sense today.
Yeah,
and Neil, just to keep butting in there, Asset Living, yes, they're the #1 student housing property manager in the country. They're based in Houston, which is actually why we like them a lot, and they liked our product. But they're also the 9th largest regular multifamily. So we have complete flexibility. We're not pigeonholed to students, and perhaps some of the audience are looking at our renders and thinking, hey, this is a little bit too high scale for students. In our mind, we're mostly targeting graduate students or perhaps more upperclassmen, as well as, of course, professionals working downtown or medical professionals.
Okay, so some people are asking, are the fourplexes on separate tax parcels? How would the common areas be maintained after a sale? So if you sell off 3 and there's still 1 that's owned by the investors, how does that work? And then also, if certain investors get a first chance to buy a fourplex at a discount, doesn't that hurt my returns if I'm just another investor?
I can answer that, or Cole, would you like to?
Yep. Go for it.
Yeah, so to answer the first part of that question, very easily, you're able to carve off pieces of a commercial reserve in Houston by a process called meets and bounds. So we will then be conveying those 4 quadplexes to up to 4, or sorry, there's 3 of the 4 fourplexes to 3 different buyers. Or of course, if one buyer wants to buy all 3, absolutely fine. It takes about a week to draw up the meets and bounds and create the reciprocal easement agreements. And there will be an HOA also added. We've met with the top HOA manager in Texas called FS Residential. And again, very simply, we can draw up a simple HOA agreement. To answer the second part of your question, the $25,000 discount, we would have to pay commissions anyway. So that $25,000 discount, is kind of a mutual saving.
Yeah, and it's already factored into the returns. And keep in mind, if you're an investor, wouldn't you like to know today that 3 of our investors went out and bought the 3 units, so you knew that you would be debt-free today instead of knowing whether you'd be debt-free a year from now? It's all about resilience. Right now, we just want to make sure that the project is resilient. And by giving away $25,000 to people, we're giving you the peace of mind that the project is going to sell 3 units a year from now and knock the debt down to pretty much 0. That's worth it.
Can this be considered as an opportunity zone investment?
Well, I'll take that one. The answer is not today. Funds going in are not considered OZ investments. However, for those of you who have not sold your stock or your companies yet, you may be able to time it very easily so that you can, we can't lease up the unit, so we have to give it to you before we lease it up. So keep that in mind for opportunity zones, but you can certainly position it. The key thing is that you would have to put down that tiny deposit now. And keep in mind that you have a 90 days, no questions asked ability to back out of that. So if it turns out that whatever it is that you're looking to sell will not sell at the appropriate time, you have the ability to back out. It's a pretty tiny deposit anyway.
And Neil, I'd like to just add a few more comments to that. So we've had extensive conversations about opportunity zones, and our attorney, who's actually representing this joint venture, as well as will be our opportunity zone attorney that we would recommend to potential OZ buyers, is DLA Piper. DLA Piper, for those of you who aren't familiar with them, they're the 5th largest law firm in the world. And our specific attorney is the partner of the SEC real estate department, as well as the opportunity zone specialist. And so we've done an incredible deal with DLA Piper to offer captive OZ funds for individual buyers of our fourplexes. And so again, if you're not familiar with a real estate development project or even a purchase, you have up to 43 months to actually deploy your equity into an asset. So if someone wants to deploy capital gains money right now, then great. We can definitely set that up, and we can set up a consultation with Paul, who's the partner of DLA Piper.
Awesome.
Neil,
Anna, before you I don't want you to move that slide. So keep it there.
Yep.
Sure, Neil.
I wanted to point out something that is on this slide. One of the reasons why we feel that it's, it's worth selling these 3 units is look at this section here.
Exactly. That's what I was going to talk about, but go ahead, Neil.
Yeah. Once we have no debt a year from today, and we know we'll have no debt a year from now because we already on the poll have a massive number of people that have signed up for that quadplex buying option. Our break-even occupancy, we've never had a project with break-even occupancy anywhere close to this. It's going to drop to 27%. And I think that's what you want to see in this uncertain world. So in the refi model, we're at 60% starting in year 3. For the 24-month construction model, it's 65%. So it's already very healthy.
It's very healthy
than many of our projects. But look at this. This is where we want to be in, right? Why take risk in a world that's filled with risk?
Yeah. We have a few people asking, was the land already purchased? Was it purchased and cleared for new construction? What is the status of the land?
John?
Yeah, no problem at all. Yeah, so we secured these sites about a year ago, and we've been progressing through land development, and yeah, we're about to close.
Okay, so just about to close, but all the development's been in process. What about the bids? That's another question people have been asking, because there's a lot of risk. Like, what if it goes over? What are the bids like? You know, what are the risks associated with the construction bids?
Well, we have a GMP contract, and our developer and builder,
John, they don't know what a GMP is.
Okay, so a GMP contract is a guaranteed maximum price contract, which means that the construction risk falls onto the builder. And furthermore, I just want to remind everyone, this is a 32-unit low-rise multifamily project. Luke Marvel and his team just completed 3,000 beds, the largest student housing complex in the entire country. So for them, and I would really encourage and invite some of the audience to check out the interview with Luke. I mean, this is a small project for these guys.
Yeah. And Neil, while you're on this slide, we've got a couple of people asking about exit cap rates, always a phenomenal question. And in this one, it's unique, right? We've got 4 different potential exits. So we had to consider the exit cap rate across those 4 models. So this shows you here that what is the current market cap rate, pre-corona, like 4.5, basically under 5 for this type of asset. Is that correct? Yep. Is that correct, John? You and I had a discussion about the broker had a pretty low number that they were saying.
Yeah, exactly. And this is across multiple sources as well. Again, I would invite audience to check out recent reports from the likes of from CBRE to HFF. In actual fact, HFF's prediction of cap rates this year for Class A urban multifamily is between 3.75 to 4.5. But basically it's around 5. Okay.
So let's establish that's where the current market is. So that's pre-corona. So what we used for the exit cap rate in 12 months related to selling off 3 4-plexes was a cap rate of 5.25. So that's for people that are purchasing. That's the cap rate we use. Now, what did we use for selling off the project related to investors? We went even more conservative, and for all 4 models, the 12-month, 24, and the 60-month, we used 5.6 as the terminal cap rate for the investors. So we think that's a pretty conservative numbers. We also have an underwriting walkthrough, as we normally do, and if anyone would like to see that underwriting walkthrough, where we show you in detail what is behind these cap rates and our research that led us to these cap rates, you can email me at anna@grocapitus.com, and I will send you a link to that underwriting walkthrough of our 4 models.
I also wanted to say that the mini webinar that we're doing for people that are interested in the quadplexes goes further into detail. We only had so much time today about the Houston market and what stuff is selling at. So this is underwriting 5.6. We when we put these up for sale, we want to sell them at under 5 cap. So in my mind, we're going to start looking to sell these for around 4.5 to 4.75 cap. But the investors that are buying the 3 quadplexes, they will get them at 5.25 cap and that $25,000 discount.
When does the pref payment start?
At certificate of occupancy, which is roughly 14 months from today. So
or 15 months after the construction loan is signed, whichever comes sooner.
Whichever comes sooner.
So if there was a delay in the project, the certificate of occupancy was delayed, it starts at that 15 months after the construction loan.
Very good point, yes.
Let's see, what type of reserves are built into the development budget in case of cost and schedule overruns? Well, we've already established that it's a GMP budget, but it does have 10% contingency in there. And then we also have some additional working reserves of about 110K built in. What do you consider to be the biggest risk to the project?
I think everybody's going to have his own opinion on that kind of question. John, what are your thoughts? I want to think about it for a minute.
Quite frankly, we like to think that we like to think that we've considered every aspect, and that's why this product is obviously in a small site, and we could have developed a podium style, much more dense product, but we went with the fourplex model. So we were trying to think of flexibility of sales to the widest population of potential buyers, and of course we've layered the product in with multiple value add features to make sure that compared to every other product really in the local vicinity, we will outperform. In terms of the biggest risk that I see, if there's no recovery in a year or two, I mean, that is the only thing I see. If there's a recession that lasts for 3 years, and I think we're all believing that it'll be a much shorter period than a year.
We hope so. And I think that, keep in mind, anything that you buy in real estate today, that's a value add project, is subject to risks that we don't have. This is unusual because new construction is usually considered to be riskier than value add. But today in value add, number one, you don't know how to determine the cap rate. No one in the United States knows how to determine the cap rate given the non-payment of rents. So you'd be going in, buying an asset that's already existing without any way of calculating the cap rate and without knowing what rents are going to get paid in May, June, July, and August. Isn't it better to take the chance to take lower interest rates for construction loans, build now, and be ready to lease a year from now when all of this stuff is going to get worked out? I'm very positive that we'll have a vaccine 14 months from today. In fact, we might have it before the end of the year, but let's say that we take 14 months. I think that's when our world truly returns to normal. So to us, the most lucrative thing about this project is it's high-speed construction, but it's also we're not leasing up in a time that is highly uncertain.
Well, and I just want to step in and add that we designed the fourplex model specifically for this reason. We wanted to create a product that was recession resilient, where mom and pop investors that aren't full-time real estate professionals, they want to take their money out of the stock market and they want to park it into a safe cash flowing asset that they can get 30-year fixed rate finance on and pay it down, right? So we have the opportunity to sell to mom and pop investors as one-off fourplexes, or we can sell it as a portfolio scattered site to institutional buyers. We also designed 2-bedroom units so that we have flexibility on the lease up. We can rent to professionals that work downtown. We can rent to medical professionals that work in the medical center. And we're talking about student housing because our proximity to the university and their expansion is just too good not to take advantage of that. But as John mentioned earlier, Asset Living is the largest student housing management company, but they're also a top 10 multifamily management company in the country. So we collaborated with them in detail to make sure that whatever happens in the market, we have a layout, a product that we could rent to any type of tenant, and the most flexibility on our exit strategy.
Since this is new construction, how is the cost segregation? What is that going to look like? And will that create a large negative K1?
We had that up on the screen. As long as we hold the project for longer here on the screen here, if you hold it past 12 months, so there's one option that the market is booming 15 months from now and we sell all 8 of those units. If that happens, no cost seg. But you're going to be really, really happy with the money that you make in that option. But if it doesn't happen, which is our default scenario, then we will be doing a cost segregation study upon completion of construction for the 5 units. We're not going to be doing them for the other 3, though I believe that we've been talking about actually offering cost segregation as a feature of the project to the buyers. So something that we're not 100% sure on, but we think that because of the units being identical, if we pay for cost seg once, then the additional cost for each quadplex that we're selling is very small. So we're likely to bundle that in as yet another feature for the buyers.
Yeah, you're exactly right, Neil.
What is the square foot and number of beds and bath for each unit?
Every
John, do you
single
have the-
unit is
Mhm.
2-bed, 2-bath, and just over 1,000 square feet. We designed that so we have more space than our competitors, while also providing our tenants with a beautiful, unit that is unmatched in the student housing space. But we really wanted to have both tenants in each unit get, one, their own private parking spot, and two, their own private bathroom. So they're just over 1,000 square feet.
And also, these units are very suitable for a couple or even just an individual. If quarantine extended or reemerges even in a year, you could be a couple or an individual that take the whole unit and turn that second bedroom into a home office, a small home office. And so in times when we're having to stay at home much more, you want those little extra features that maybe otherwise you might not value as much. Higher ceilings, bigger windows, a balcony, and obviously just a beautiful finish throughout. So yes, it can be two roommates or it can be a couple or an individual that has 2 bedrooms.
I wanted to take a question that came directly to me through chat, Anna. What
Sure.
happens if you're sold out? So the answer is, at this point, our project is oversubscribed. So we are looking at a third plot of land, also in the same area, with the same exact metrics. So instead of building 2 16-plexes, we would then build a third, because it's likely that we would have to build it given the astonishing results of our poll.
Awesome. Neil, I'd like you to take this one. So does this mean we won't have any dividends for the first 14 months?
That is correct. So essentially, there's no cash flow for the next 14 months. It could be a little bit shorter than that, looking at the interest on this poll, could be 13 months. But yes, because during that time, we are spending money on construction. We don't want to raise money simply so that we can give that money back to you. So you are waiting. Now, keep in mind, construction projects, even our construction projects, typically don't have any returns for 30 months. This is unique because of the fact that we don't need the concrete and steel constructions with elevators for the large projects that most people do. These projects are much simpler to put up, and so the construction speed is way, way faster. So 13 months is actually unique, and I can't say that that's the case with any of our past projects.
Well, Neil, you may also want to talk about what's happening in the value add world for the next 6 months or so. We don't know if there's going to be distributions. So
very good point. Show me a project today from a reasonable, balanced syndicator where the syndicator is saying that you will actually get cash flow. Every syndicator, and I myself have invested in 16 passive syndications. I can tell you that all 16 of those projects have suspended distributions. To be honest, if you're interested in any kind of passive investment for the next 6 months, you're not going to get distributions, and we think that's the right thing to do. So you don't really have a choice today in that world, which is why it makes sense to look at a new construction project today.
So what is the benefit again of paying off the construction loan rather than using a takeout loan to take advantage of leverage for the 5-year model? Neil, do you think you could throw up the 4 exits?
Yeah, I want to do that, but I also want to give you the option. The answer is de-risking. Our focus is on de-risking the project. Yes, we absolutely could take a larger loan, pay you some of the money back, and then basically use leverage to juice our returns. It would significantly increase the numbers that we've shown you here, but that is not the approach that we're taking. We want our investors to be the ones that want debt-free investments in this uncertain time. So to us, we had the option of doing that. There's nothing wrong with doing it. We just feel that today, the debt-free option is one that appeals to other investors, and it appeals to us.
I also want to point out, if you look at the 5-year hold versus the 5-year hold no debt, and you look at the equity multiple line, the 2.08 versus 2.15. So the last line there is indicating that in the same time frame, you're actually making a little bit more actual money with the 5-year no debt. The big difference is the IRR, because in the 5-year hold, because of the refi, you're getting a bunch of your capital earlier. So that's why that number is so much higher. because you get a bunch of your money back. So then that is some sort of de-risking for you, but you have less money left in the project that's earning returns for you. And then you have to find something to do with that money. So I really like the 5-year no debt model that I feel like, as Neil says, really de-risks the project. And I feel, I look at those numbers, I see them as fairly compatible.
Yeah.
And you're really not constrained to any of these options, are you? They're just
Right.
flexibility options.
Right, absolutely.
Value to investors as well as ourselves, of course. Even,
Right.
We're selling down the a project, you have zero debt, that's amazing. We're completely risk-free during that period. And at any time, we can decide to refinance, pull equity out, or of course, sell the project.
Yep. So these are all options. And I think that we're starting off with the no debt option as a default options, but a year from now, we'll check the pulse of the market and check the pulse of our investors.
Let's see, we've got people asking for what is the cost of the fourplexes? What is the cost of the fourplexes? So
it's about $1.3 million. You'd have to come to the other webinar that we're doing. I know that a lot of you have signed up for option or priority 1B. If you accidentally signed up for priority 1A, do let us know. You can let us know by emailing us, and we will send you an invite to that. But that particular webinar would give you more details on, okay, what's my cash flow going to look like? How much money am I going to make each year when I buy these? And what is my 5-year or 10-year horizon? How much money can I make? All of that is going to be in the other webinar. This webinar is for the syndication. We know that there's lots of investors here who don't want to buy quadplexes, so we can't cram all of that stuff into one webinar. That's
true. That's very true. Let's see. Can you show a rendering of the boundaries of the fourplexes? Somebody's wanting to say, so they didn't quite catch the boundaries.
Sure. Yep. You can go ahead and ask the next question. I'll show the rendering.
Okay. Who and how makes the decision of which exit strategy to follow?
The management does. You're trusting us to make those decisions. So Grocapitus and Urbanist would sit down and basically decide what it is that we want to do. In general, our thought processes are very aligned. We tend to be risk averse. So we're more likely to take the risk averse option if the market is still shaky. But if the market is not shaky, then we'd like to maximize your investor returns. And I think both parties have had extensive discussion. And I think we're very aligned in that.
Exactly.
I think this one is right up your alley, John. Himanshu is saying that 60 to 70% of Houston jobs are oil-based. And with the advent of electric car and renewable energy options, isn't Houston another Detroit waiting to happen?
That number is completely wrong, Himanshu. I think that we're going to show you our slide on that. And I want John to take this question because this is a key
I know he's
question.
Very passionate about it too. I can hear him chomping at the bit.
But that number is definitely not correct. So we're going to throw up a slide for you, but go ahead, John.
Well, yeah, I mean, firstly, that number is absolutely not incorrect. But yeah, great question. Obviously, everyone thinks Houston is only based around oil and gas. And I think it's approximately 7.5% of jobs are related to the oil and gas industry. And Houston specifically only produces less than 1% of actual oil. So a lot of the oil industry in terms of production is outside of Houston. But of course, Houston is still related to oil, and in the advent of, demand for oil is inelastic to price. And for the next 10, 20, 30 years, the demand for oil is not going anywhere.
And one of the things that I want to point out one more time, which will show you the strength of the Houston economy, there's been an oil meltdown in process all of 2019. I don't want to call it a meltdown, but there's certainly the price of oil decreased. Shale providers were having trouble. All kinds of bad things happened to oil all across 2019 with prices declining. During that year, when Houston lost a bunch of jobs in oil, it was still the second fastest growing economy in terms of jobs in the United States. Would have been first.
That's right.
If there wasn't an oil meltdown in progress. So yes, there is an impact, and you're right, there's an impact, but it's not the sort of impact that you're imagining. And last year is the proof of that.
Yep. So I've got a quick one here. What is the timelines for submitting funds for investment? So the funds for investment to the investor LLC would be by May 11th. So we would be, docs will be going out 24 hours after this webinar. And then those are e-signed docs. And then those of you that return signed docs, it's all based on timestamp. That's how you get into the raise. Those people that get in will be asked to wire money within 5 to 10 days, I guess.
Yes, so your place in line is held by your signing of docs. It's not based on, you know, the poll that you just mentioned. The poll gives you a slight advantage, it does. But I think that the key thing is that you sign docs as quickly as possible, because we are now projecting this raise to be oversubscribed massively.
Yeah, I just wanted everybody that said that they are interested in general will be getting the link to the docs in 24 hours, and that's when you have the opportunity, based on the speed of your response, to take a spot. Can we convert the initial investment to down payment on the quad if we choose to buy it?
We're not doing that because there are a number of legal logistics and challenges with it. No. So your investment stays in the project. But think about this. So let's say that you invest $100,000 into the project, and then you want to go buy a quadplex from us a year from now. Imagine that if all 3 quadplexes were purchased, why would you want to pull your money out of a syndication project like that? I want to put my money into a syndication project, you know, like that at that point of time, because, you know, you've already gone through the construction risk, you've already gone through the lease-up risk, and you've already gone through 3 quadplexes being sold. Why would you want to withdraw from the syndication? Because if we gave you your money back, you wouldn't make any money, because you took your money out. Why would we give you returns on money that you're withdrawing from the project? So I think it makes no sense from our perspective, and it definitely doesn't make sense from your perspective.
All development projects that I have invested in that are in for permits have reported significant delays. Have these timelines been accounted for in delaying permits, given the importance of delivery timing in summer for student housing? Is the fallback simply to go market rate for lease up?
Good question. John?
Yeah, great question, of course. A lot of the Houston's permitting has moved to online fairly successfully, as I understand. You know, Luke obviously has a good relationship with permit expediters on this matter. Secondly, some larger projects are going to fall off, so that alleviates some of the demand and pressure on the system. And then thirdly, we, again, with everything throughout our underwriting and projections, we wanted to err on the side of extra caution, and we gave ourselves a 12-month development construction timeline. But quite frankly, and Luke mentions this in his interview, he can do this in 8 to 9 months. I mean, they were building 175 townhomes a year. We're building 8 fourplexes. So hopefully that gives some assurances on that matter.
Yeah. Let's see. Can you explain the 60-40 profit split, Neil?
Sure. So essentially what this means is that after we pay your pref, there's an 8% pref. Let's assume that the project is a 5-year project. So in that case, you get your 8% for year 1, year 2, year 3, year 4, year 5. So that money goes to you first, to the investors, until all investors have received an 8% annualized return. Now that with the money that is left over at sale, right, once you sold all of them, you take that profit and 60% of it goes to the investors. In addition to that 8% return, 40% goes to the promoters of the project. But again, we don't make any money at all until we first given you an 8% annualized return, which is what the pref or preferential treatment means.
Mm-hmm.
And returned all capital, of course.
Yep, and returned all of your dollars, yes.
Neil, can you explain again, what's the registration link for the other webinar?
There isn't one. The only way to really get into that webinar is to indicate interest. One way of doing that was the poll. Another way is to send an email to us so that we can do that. Now, we do want to send the recording of that webinar out to everybody. So if you're watching this, don't worry, you'll get the recording of that second webinar. But if you want to attend it live, let us know. Let us know in any way, and we'll basically enroll you into that webinar. What we didn't want to be doing is email blasting our entire 28,000 person database with 2 different webinars.
Yeah. Neil, can you throw up the break-even occupancy for each of the models?
Yeah, that's actually one of my favorite slides.
I know.
I was looking
when
for
I figured out the
to do
break
that.
even, I was over the weekend and I was working all weekend, and I slacked Neil, and he couldn't believe it when I sent him the numbers. 27% is the break-even occupancy for our preferred model, and then for the 12-month model, obviously the 12-month model is irrelevant because we're selling them before we even rent them out. The 24-month model is using the construction loan, so that is 65%. And then if we go 60-month with a refi, it's 60%. So it'd be 65% for the first 2 years, and then once we refi, it's 60%. But our preferred model that has no debt after construction is 27% for the break even. And we, by the way, in the investment summary, which is included with the docs, when you get the docs, you will have a 60-page or more investment summary. And all 4 of the models are in there, along with detailed sensitivity analysis for each model. Let's see, isn't it true that in bad times, tenants flee from A properties to B properties? If so, why will that not be the case in this property if bad times continue at time of lease up?
That is a very common misconception. It certainly didn't happen in 2008. So here's the facts. What I'm about to tell you is not my opinion. Number one, in 2008, occupancy for Class A, Class B, Class C were not the way that you're describing it. Class A didn't lose much occupancy at all, and whatever occupancy it only lost for 1 year. Class B lost it for about 18 months, but still was very minimal. It was Class C occupancy that was lost in 2008. Now, it's going to take me about 45 seconds, but this is a question that comes up a little bit too much. It's a perception. It's not the truth. I want to prove it to you, so I'm going to actually bring up a graph that proves it to you. Go ahead, Nana, with the next question, and I'll bring this up.
Okay, so let's see. Are self-directed IRAs or solo 401ks eligible for investment? The answer is yes. Then Neil, I think you'll have to answer you're better at answering the second part of the question. Are there any tax consequences or limitations of investing this way?
You know what? I would refer that to your IRA provider. Obviously, when you are investing using that kind of money, you're already receiving a very significant tax benefit upfront. So there's definitely some downsides there. I would refer you to your IRA provider for that.
Okay, is this property on a flood zone?
It absolutely is not. It is not on any kind of flood zone, not even a 500-year flood zone.
What is
and by the way, before you go back, I want to go back to that question that was asked of me. Yes. So please take a look here. This blue line, and you can see this is 2008, 2009. And by the way, this has happened in other recessions as well, but I want to use the most extreme example. You notice that Class C occupancy vacancy spiked and then stayed very high for about 2 years until it came back down right around Q2 of 2011. See how long it stays high? Now take a look at the light green line. You notice that the Q2 2009 spike, if you want to call it that, is only about half a point higher than where it was in 2003 or 2006. So looking at it, it only spiked, and notice that it only spiked for half a year, and then it came back down rather quickly, and since then, it's actually been fairly stable. Now, it's gone up just a tad bit here, still phenomenal numbers, but it's gone up a tad bit here because there have been new apartments delivered in 2017 and 2018. But still, and you know, your Class C vacancy has declined here, but your question was, what happens to to vacancy in a recession? In a good time, Class C seems to be doing better. In a bad time, this should very clearly tell you that Class A and Class B do better. Why? Because the people with C only have $500 in their pocket. When they lose jobs, they simply cannot afford to live anywhere except with mom and dad.
I also maybe just want to make an extra point on that. You know, obviously we're talking very general, you know, Class A nationwide. Mm-hmm. Also, yeah, for all sizes of properties. I don't expect, this is probably an unknown fact, but smaller properties have a higher occupancy. So last year, the average occupancy for small balanced multifamily properties, and what that means is typically under 50 units with a loan balance of under $10 million. That's really the definition. The average occupancy was an incredible 97%. And even that is still an average. So that's all asset classes and across the entire country. We don't believe that our product in an urban core, with all its great features and its proximity to a variety of key amenities and locations, is an average property. It's also a brand new property as well. So we can look at averages and generals, and then we've just got to really put into perspective, okay, how do we think our property will perform?
What is the process for using the electric bikes? What if they get damaged or stolen?
Great question, really good question, and we definitely debated this, and we've got really two solutions. We haven't decided on the option right now. So either, of course, this is going to be optional. We're going to have a series of electric bicycles. It's included in the budget. I actually went to California to sample a couple of different electric bikes, and really happy with what we selected. And so the two options we are believing we will say to tenants. Either they can pay an additional security deposit, so that's one way of tackling this, or we can just add it on to an additional, like a rental fee per month. So we could say, okay, if you're going to rent the electric bicycles, then we'll charge an extra, $30 a month. So over the course of the year, that's nearly $400.
Okay, I want to go back to actually the first question, which also relates to several questions in here. Hi, Neil and Anna, how did you find this deal? And then also talking, other people are asking, how long has Grocapitus and Urbanist worked together?
Well, to be honest, they've been fans of ours for a while, and so they've been following us, not the other way around. I ended up teaching together with the mayor of Houston at a large conference, and in Houston, yeah, I was teaching in Houston. And that's where John met me. I think Cole was there too. I'm not 100% sure. And I think that was just this instant connection. I think we had been looking for a project like this. And just so you know, we're looking at projects like these, the quadplex, collections in multiple metros. So what they mentioned immediately resonated with us, because we're like, that's the kind of project that we want to do, given where we are with the economic cycle. So, but they've known about, Grocapitus for quite a while before we knew about Urbanist, when I was teaching in Houston.
Yeah, exactly. We were keeping a lot of this under the radar, quite frankly. But our relationship started with Grocapitus. I think it was approximately a year ago. We were at the Opportunity Zone conference in Vegas. I think that was actually last year. And myself and Anna had a really good conversation. And then, it's blossomed since then.
Yep. Okay, I think we are a little bit after time. If there's any questions left that anyone wants to jump on, I'll give you each one question, but we are over time, my friend.
Those of you that for some reason the poll didn't come up on your screen, don't worry about it. Send us an email. I've already seen 7 or 8 emails in my mailbox for people that, for whatever reason, the poll didn't come out for you. Please send us an email. Don't worry, it's not going to affect you, but do let us know the amount when you send us an email.
Neil, any question you want to jump on here?
No, I think honestly, you guys have grilled us a lot.
yeah, we covered almost like everything here. And some people, I do want to say that there was an issue with timing. Some people thought the webinar started later than it actually did. So they joined late. And so the webinar replay will be sent out along with the webinar deck within 24 hours via email. So you all, I'm sorry that there was a wrong time. We will look into it. And if you did not, you should have had a chance to fill out the poll. But if you're watching the replay and you didn't get the poll, then email us, like Neil said, and say, hey, here's what I'd like to do. I'm interested at this level, whether you're interested in investing in a fourplex as well, and we will invite you to the next webinar.
Yes, and I want to thank John and Cole and also Henry, who's on the webinar, but wasn't speaking. We'd love to meet with you guys in Zoom, and Thank you for all the work that the team has put together on it. And thank you, investors. Have a wonderful rest of your evening. And please, please stay safe. Thank you.
Bye, everybody. Thank you.
Bye-bye.